Hi there, welcome to the Candlestick Formations video. We're going to look at several of the more popular candlestick formations, and they are good for every trader to be aware of. They can help you get out of a trade early before it reverses against you, or it can help you from getting into what could potentially be a bad trade. These are going to be the more popular ones, the ones that almost every trader is aware of, and because of that, they do carry some weight in the market. First, we'll start out with the engulfing formation. A small-bodied candle is engulfed by a big-bodied candle of the opposite color. A bullish engulfing will appear at the bottom of a trend, while a bearish engulfing appears at the top of a trend. Bullish engulfing is a small-bodied candle, generally a bear-colored candle, and then it is followed, the pattern now is a bigger candle. The body is bigger than the small candle, and it is of the opposite color. A bullish engulfing candle is a small bear candle followed by a big bull candle. A bearish engulfing happens at the top of the trend. It's a small bull candle followed by a big bodied bear candle. The harami, or the inside bar. This is the exact opposite of the engulfing. A candle with a large body is followed by a candle with a smaller body. And it's kind of neat to note that in Japanese, harami means pregnant, so this is a good way to remember that. The body of the second candle is contained within the body of the larger candle to the left and is of the opposite color. Now we're going to look at some different kinds of dojis. Now this is the doji. It's valid when it appears at the top or bottom of a market move. The open and the close price is the same or is very close to being the same. Where the candle opens is where the candle closes. The body is very narrow, and the candle opens in the same place it closes. The length of the upper and lower shadows are small as the market has lost momentum. So there is a type of balance when this doji candle is formed. There is not the tug of war, there isn't the pull. The bulls and the bears are, for lack of a better word, content with the current price. And from there, after a long move up, market will generally want to take a move down. And vice versa. If you see it at the bottom of a long move down, you get a little doji, the market will want to move back up again. Next, we have the long-legged doji. Again, the open and the close are at the same price, but the upper and lower wicks are very long. The market is frantically looking for a direction. There is a period of indecision, but at the top or bottom of a trend, the temptation for the market to reverse becomes very strong. There is a battle going on. Because of the length of the wicks, you can tell that there is that competition between the bulls and the bears. There is a tug of war going on. But when you see this formation at the top or the bottom of a longer move, the market will generally change direction. Next, we have the gravestone doji. With a long wick, the open and close of this doji are at the bottom of the candle. The long wick is at the top of the candle. It's the top part while the body is at the bottom. This is a great formation denoting the end of an upward trend, but can on rare occasion also be found at the bottom of a trend. This formation, this gravestone doji, is also referred to as a pin bar. You'll find this at the top of a trend. Market will move up, form the gravestone doji, and then from there come back down. The opposite now is a dragonfly doji. This is the opposite of the gravestone doji. Its open and close again are at the top of the candle formation with a long lower wick. This is a formation that will clearly determine the bottom of a trend, but will occasionally appear at the top of a trend. This also is referred to as a pin bar. Next, we're looking at the hammer and the hanging man. The candle formation is exactly the same, but its name is based on where you find it in the trend. A hammer appears at the bottom of a move. The hanging man appears at the top of a move. It's a small body and a longer lower wick, with either no upper wick or a very teeny little tiny one. The length of the lower wick is approximately 2 times the length of the body. And when you find this formation at the bottom of a move, chances are market wants to go up. And when you find this formation at the top of a move, the market is going to want to change and come back down. The color of the body in these hammer and hanging man formation doesn't much matter. but it's been said that the effectiveness of the formation is better if the hammer's body is white and the hanging man's body is black. So at the bottom of a move, you get a bullish color, and at the top of a move, you get a bearish color. This gives you a higher probability that this formation will work out. Inverted hammer and a shooting star. This is the same as the hammer and the hanging man, only upside down. The inverted hammer appears at the bottom of a move. The shooting star appears at the top of a move. The upper wick is double the length of the candle's body, and this candle has either no or very small lower wick. The railroad tracks. This is an instance of a quick change of mind by the markets. It's composed of two similarly lengthy candles that are longer than the average surrounding candles. The railroad tracks candles stick out like a sore thumb. Strong urge in one direction followed by an opposite candle. So there's a strong forward surge, which is pulled right back, or a strong downward surge, which is pulled right back. And this can appear in a sideways market more often than not. They are good reversal candles in moving markets, and they can also be found in relatively quiet times. In these cases, it's almost like a glitch in the works. There is very little in the way of an increase in momentum. Railroad tracks in a quiet market should not be traded, or traded with extreme caution. Now, wicks in general. Without looking for a specific candle formation, the wicks are important to pay attention to. Whether or not the candle body is longer or shorter than the average, a long wick will often point to a change in direction. A long wick on a single candle means that during that formation of the candle, there was more than usual aggressive battle between the bulls and the bears. Whoever was able to push the charge back to actually form the wick is generally going to keep pushing. An initial powerful surge upwards by the bulls is met with retaliation by the bears pushing it back down. The bears defending their control over the market will continue to be aggressive for a short while afterwards. So a wick on the top of a candle will imply that the market wants to keep moving down. Simultaneous wicks. A series of wicks is a heads up to a change in the market direction. As price keeps trying to push in a direction, it is being continually met with resistance. Eventually, this resistance will take over and push price in the opposite direction. So when you have a series of wicks that appear one after another at the top of a move, and the wicks are at the top of the candles, the market will want to drop. And if you have a downtrend and then candles start being formed that have longer than average wicks at the bottom, and you'll have 1, 2, 3, 4, maybe 5, you'll have a series of lower wicks at the bottom of a down move, the market is going to want to move up. Well, thank you very much for watching the candle formations video. Take care, and I'll see you in another video.